holidays and welcome to Investing Insights. I'm your host, Ivana Hampton. This week, we're looking back at 3 discussions we held earlier this year about exchange-traded funds that income investors might find attractive. You'll hear from 2 Morningstar ETF specialists. They're talking about dividend, bond, and covered call ETFs in 2025. Let's start with dividend ETFs. This style of investing can focus on income or growth. The strategies can have different risk-reward profiles. I sat down with Bryan, Armour in February. We discussed how certain risk factors can affect dividend income. The director of ETFs and passive strategies research for North America at Morningstar Research Services also spotlighted 4 dividend ETFs that earned top marks from Morningstar. Now, dividend investing can result in exposure to factors like value, quality, and low volatility. Can you briefly explain, 1, what is factor investing, and then where do dividend ETFs typically land?
Yeah, so factor investing is basically looking at the different risk factors that affect a stock or are able to like quantify for each stock or portfolio. So when you talk about value, like what is the price relative to its fundamental value, like book value or earnings, and then something like quality could be like how consistent is this company's earnings, or how profitable is the company, and then low volatility is just a backward looking, like how volatile is the stock over some trailing period. And so factor investing is a useful way of just understanding the risks of the stock you own. And so dividend income strategies tend to push into value, and like higher yielding companies tend to be priced at a lower price because there's less growth opportunities for those companies. And value tends to run counter to quality in many instances. And so dividend income tends to be higher in value, potentially higher in low volatility, and then a little lower in quality. And then dividend growth, a little bit higher in quality, but also pushes not as far towards value. And then, also low volatility strategy.
And how do you find a dividend ETF that provides the optimal or just right amount of factor exposure? And what should appear on our checklist? I'm going to write it down.
Some value. You're looking for some value and low volatility exposure without sacrificing quality is really what you want to do. And the best way to do that is look for ETFs that can control the risks inherent to the strategy, and then also take steps to diversify the portfolio more broadly and limit the implementation costs of the strategy. So low turnover, low fee, all the normal things that we look for in high quality funds.
Gotcha. Well, 4 dividend ETFs hold Morningstar's Medalist rating of gold. Let's start with the 2 dividend growth ETFs from Vanguard that hold these marks.
Yeah, Vanguard Dividend Appreciation ETF, which is ticker VIG, and then the international sister version of the strategy, which is ticker VIGI, which I own. Both look for a long track record of increasing dividend payments from the companies that they hold. For the U.S. strategy, it's a 10-year look-back period of every single year increasing dividend payments. For the international strategy, it's 7 years. But what that does is it picks up companies that are high quality, that are consistently profitable, and then it market cap weights them so that you don't end up having that much active risk moving away from the market. It's easy. There's less turnover and less rebalancing to do at each rebalance, and so that keeps costs down for the fund. And obviously, both are very cheap compared to category peers.
And explain why Vanguard's top dividend income strategy also impressed Morningstar analysts.
Yeah, Vanguard High Dividend Yield ETF takes a different approach where it filters down to companies with above average dividend payouts, and then still market cap weights those that remain, which keeps a broadly diversified portfolio, lowers implementation costs. That one gives you a little bit more yield than the dividend growth strategies. So it's significantly higher than the market, but not crazy. There's a certain trade-off between going too high on yield and risk, and so it does a good job of balancing the two.
And the final and fourth gold rated dividend ETF mixes both income and growth strategies. Talk about the one from Schwab. I own this one. You own this one. What do you have to say?
Schwab US Dividend Equity ETF, which is ticker SCHD, does a really good job of explicitly targeting dividend, consistent dividend payers with explicitly targeting profitable companies. And so it's that combination that does a really good job of looking at things like value, low volatility, and quality all in the same portfolio. But it is more targeted. The portfolio is smaller than the Vanguard ETFs with 100 stocks. But I think you could expect higher income and also higher profit, more profitable companies in that portfolio.
Next up is bond ETFs. The editor of Morningstar's ETF Investor newsletter, Dan Sotiroff, joined me at this table in November to explain why these exchange-traded funds are surging in 2025. The Morningstar Research Services Senior Manager Research Analyst also shared some investment ideas. Well, bond ETFs are having a banner year. Why are investors turning to these investments?
Well, yeah. So maybe just to set some context here, right? We've had about $1 trillion flow into ETFs so far this year. I think we're actually a little bit over that amount. Somewhere around 30 to 33%, roughly a third of that money is going into bond ETFs. So it's so insignificant component of the inflows going into ETFs. So to your point, like they're having a pretty big year in terms of their popularity overall. I think there's a couple things behind that. One is just the ETF is becoming the vehicle of choice, right? We're seeing investors of all types just preferring that vehicle for a variety of reasons across the board. So there's definitely a tailwind helping them out in that regard. And then asset managers are more or less responding to that. And they're just creating a lot more ETFs. In some cases, they may be taking like an actively managed strategy, adapting it to the ETF wrapper and putting it out there. In some cases, you're just seeing a lot of net new stuff coming out as well. And you have to remember, right, we have roughly about, the Fed funds rate is around 4% right now. You go back 10 years, we're in zero interest rate, so bonds actually have a return now. So they're kind of attractive in that regard. And then the other thing I would point to is that a lot of stock ETFs are just really picked over, right? We've seen kind of everything. We've seen indexes, strategic beta, thematics, ESG, all that type of stuff. It's all out there. It's pretty saturated, and a lot of the stuff is already kind of competing on price. So when you look at the new areas that you can actually go into and maybe compete in or get a first mover advantage, I think it's going to be more in fixed income in the bond market.
What makes a core bond ETF a solid building block for a portfolio?
Yeah, great question. I think the first thing to consider is just what are the rolled bonds in your portfolio, right? And I think most people are using them as sort of like ballast to balance out the risk that they have with their stocks, right? And whatever allocation is right for you is sort of something you have to answer yourself and talk to your advisor. But that's really the main thing, and it's for two reasons. One, they're less correlated with stocks. The correlations are very low, if not negative in some cases. So you get that mathematical diversification aspect of them. And then they're just less volatile overall, right? The standard deviations, the statistical measures of risk that we tend to use in evaluating investments are just going to be much lower than stocks. So that's really sort of the basic component that bonds serve in any investment portfolio. And when you look at core bond funds, they check both of those boxes really, really well. Very low volatility, broad exposure to the bond market. They're an excellent diversifier, low risk in general. So that's really what you're getting with like a basic core bond ETF.
And what's a top idea that Morningstar thinks very highly of?
Yeah, I'd just start with those very basic bond ETFs from iShares and Vanguard. Vanguard Total Bond Market ETF, the ticker is BND, and iShares Core US Aggregate Bond ETF, the ticker is AGG. Both are tracking the Bloomberg US Aggregate Index, charging the exact same fee. You can't go wrong with either one. So pick one. I don't have a favorite. They both do the same thing. They're both going to give you the same ride, more or less. So start there. That's pretty basic, pretty cheap. You know what you're getting. It's very predictable. But yeah, those are great places to start.
Now we're going to shift from the least risky to the next level up, which
Yep.
is Core Plus. What do these bond ETFs typically offer that a index tracking ETF doesn't?
So, like I said before, the defining trait of like a core plus strategy in general is it's going to have a little bit more exposure to sort of high yield bonds. So it's going to up the risk a little bit. They're still very broadly diversified. They still kind of tie themselves to the broader bond market. So you're still going to see a lot of treasuries and investment grade corporate bonds and that sort of stuff, mortgage backed securities that kind of dominate the bond market. But you'll have a little bit increment of higher yield. So you get a little bit higher yield, but it comes with a little bit higher risk, but still a very good diversifier, still very low correlation with stocks. So they still serve that core bond purpose.
Can you tell us one intermediate Core Plus bond ETF that has earned a gold rating from Morningstar?
Sure. So Fidelity Total Bond ETF, the ticker is FBND. That's been one of our favorites for a long time. It is actively managed. But it's been very reliable. It's generally produced exactly what we would expect. Taps into all the major segments of the bond market, like we said. And then, as I've been alluding to here, has a little bit incrementally higher exposure to the high yield bond market, and that's where you get the extra yield and the extra return from. So, but it's been one of our top picks for a while now.
We're cranking up the risk.
Yep.
Multisector bond ETFs take on a bit more risk.
Mm-hmm.
So that comes with an expectation of more income. Should
Yes.
income investors skip the other two and just start here?
Not necessarily. And that's something that you have to, again, take a step back and figure out, like, where are you? What do you actually need in your portfolio, right? It's an option and the yields are going to be higher. But again, there's a trade-off there. There is incrementally more risk. So just be aware of that, right? So maybe you can look at that. But if your income needs are being satisfied with the other ones, then, maybe you don't have to. So make sure you look into that. Don't take on more risk than you necessarily need. But yeah, you hit the nail on the head. You're taking on incrementally more risk. Multi-sector bond ETFs and mutual funds, for that matter, like the main goal here is to up the return, and really that means upping the yield. And they tend to have an income focus, and some of them even have income in their name. You may not even know it's a bond ETF until you actually look into it a little bit. So, but yeah, that is sort of the end goal of these things, and they do still offer a reasonable level of diversification. So the risk is going to be a little bit higher than your core bond ETFs, but they're still relatively low correlations with the stock market.
Well, it's time for the third top idea. Dan, what multi-sector bond ETF should investors consider?
Yeah, so it's one we've talked about a lot before. I featured it in the newsletter at least once, maybe twice now, I think. But it's JP Morgan Income ETF. So that's no bond in the title there. It sounds like an income ETF, but it's a multi-sector bond ETF. At the end of the day, that's been one of our favorites. It's got a gold rating on it right now. So we're big fans of the team and the general process that they're following. So I would start with that one.
Now, high yield bond ETFs are the riskiest among the categories that we're discussing
Yep.
today. What additional risk are investors taking on when they look at these investments?
Yeah, so it goes back to the two risks I've been discussing, right? Like it's the diversifying aspect with stocks than just their exposure to the overall stock market. So they're going to be more volatile in general because they are riskier, they're higher yield, they have lower credit ratings. But the other side of it is the diversification aspect is they are a little bit more linked to the stock market. They have like this equity-like risk to them. So if the stock market were to take a pretty big dive, you're probably going to see your high yield bonds take a pretty big dive too. And that's if you're looking at them as a diversifier, they may not serve that purpose as well as maybe a core or core plus bond ETF. So just keep that in mind. The yields are enticing, but they're not going to give you the same ride as like those more stable core bond ETFs will.
So something to remember.
Something to remember,
At
absolutely.
the juicy yields.
Yes, in this day and age, yields are very enticing, but you got to be careful.
Morningstar does not currently rate actively managed high yield bond ETFs. What top idea do you think investors should watch?
Yeah, so like you said, we don't rate any right now, but we're looking into it. We do rate some mutual funds. But they're starting to come online. There's more and more of them are coming out. One of them we have talked to the manager on is Vanguard High Yield Active ETF. It's relatively new, just came out a few months ago. It's going to be a little bit different from the mutual fund. I think they're adding a provision where they can take on a little bit more risk than the mutual fund, and they can get into some CCC rated bonds when the opportunities present themselves. But that's one we've been keeping our eye on. And when you look at the fee on this, very Vanguard-like, it's 22 basis points. It's like half of what Capital Group and JP Morgan are charging for theirs. And they also have ETFs that came out this year too. So those are other ones to keep an eye on, but the Vanguard one just looks so attractive on price. It's hard to pass up.
It always comes back to fees, Dan.
It does. It does.
Another group of exchange traded funds are booming this year. You guessed it, cover call ETFs. This strategy consists of owning an underlying asset and selling a call option on top of it. In July, Dan and I talked about these ETFs' appeal and the trade offs investors are making. He reminded us that not all yield is good, although one ETF is doing a solid job. What's making them so popular in
Yeah,
2025?
it's really an income story, right? Like you look at the yields on some of these, and that's what's really attracting people a lot. In the past, it was always like bond funds, and then bond yields went to zero when we were in the zero interest rate environment in the 2010s. And it was dividend funds were all the rage for a while because the yields were higher on those, so people chased after those. Now it's covered call or option income strategies right now because the yields are incrementally higher above those dividend funds or those bond funds that we have right now. So it's really what the story is. It's people are just chasing after the income or the yield.
Now, you just mentioned that the yields are very high. What's driving that?
Yeah, it's the premiums from those option contracts, just by the way they work and what the premiums actually, cost. They're a lot higher than what you're going to get out of a dividend fund or a bond fund today. So that's really what it boils down to. There's a couple caveats with that though. Those premiums change over time, so they're not static. So the yield that you get from these ETFs could change by a lot. If you want a really good example, we'll look at the trailing 12-month yield on JP Morgan Equity Premium Income ETF. The ticker is JEPI. It's one of the more popular option income ETFs out there right now. The 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 trailing 12-month yield on that ETF has landed somewhere between 6.5% and 12% over the last 5 years. It was launched in 2020, so we have about a 5-year history. So it gives us a pretty good idea. But still, like you're going from 12% down to 6.5%. Like it's basically almost getting cut in half, right? Or it's doubling from 6 to up to 12. So you can see some pretty big swings in the income that you're getting from some of these ETFs. The other thing, along those lines is that the premiums are tied to the volatility of the underlying asset, and that's why they swing so much. So as the asset gets more volatile, the premiums are going to go up and the yield is going to go up. But as the asset gets more stable, the premiums are going to go down. So that's just something to be aware of as you're getting into these things. Is it may not be reliable, but it's going to be higher than what you get out of a dividend fund.
What types of trade offs are investors making?
There's several. First is that the income just doesn't magically appear out of nowhere, right? There is a transaction taking place in the background. And really what you're giving up is you're giving up the long-term growth of the underlying asset. You're basically trading tomorrow's price appreciation for income today is the way I sort of think about it. So you're not getting the growth of the underlying asset plus all this additional income. It doesn't work that way, right? So you're earning that income from the option premium, but the option essentially is adding a cap on that underlying asset on how high it can grow. And that's basically the mechanism that's at work here. And because of that cap, the total return on your covered call ETF is more than likely not going to outperform the underlying asset. You're inserting some additional friction into the picture, and you're more than likely going to underperform. So bottom line, if I'm looking at this as an investor, these don't make for great long-term investments. If I'm young and I've got the risk tolerance and everything like that, you're better off just being in sort of a low-cost S&P 500 ETF or something like that, right? Where most of your gains are going to be price appreciation, and it's going to be a little bit riskier. So that's the really big thing I think that most people should take away. These are not great long-term investments if you're in that accumulation phase of your financial plan in life.
Which cover call ETFs do Morningstar analysts consider a solid choice for investors and why?
Yeah, there's one that we really go back to, and it's one we've actually rated in-house already. So that's JP Morgan Equity Premium Income ETF. We referred to it kind of before. The ticker is JEPI. It's very well known within sort of the covered call, ecosystem. It's one of the biggest ETFs or covered call ETFs out there right now. We have a bronze medalist rating on it at the time. Sort of getting back to that price point, the expense ratio is 35 basis points. That's cheaper than about 92% of the covered call ETFs or the ETFs in the derivative income category right now. So we love that it's a relatively low fee compared to other options out there. And fees matter a lot in whatever you're looking at. So that's huge. There's a few other things sort of around the margins that we really like. That manager's name on this fund is Hamilton Reiner at JP Morgan, and we think he does a few things at the margins that are really good. He builds the strategy around S&P 500 stocks. So these are big liquid stocks. It's a diversified portfolio. So you're not going after the single stock ETF that's going to subject you to all this, crazy risk of a single stock. And then he's very aware that you are sort of exposed to the full downside of those stocks. So he does build a sort of defensive stock portfolio from those stocks, which is one thing we like. He also sells slightly out of the money call options. And he does that to kind of preserve a little bit more of the index's upside because he knows the option is going to cap that upside, right? So he's trying to give you a little bit more incremental return from the price appreciation there. So he's aware of all that type of stuff. And then the other thing he does that's a little bit different is he sort of eases the tax burden on people. He doesn't use call options directly. He uses something called an equity linked note, which is, we're not going to get into the details on that. Basically, what it does is it gives him exposure to the profits of the call options without owning the call options directly. And the consequence of that is that the income is going to be taxed as ordinary income. You're not going to have to deal with the goofy 1256 contracts or anything like that, or that 60-40 split. The downside is it's all going to be taxed as ordinary income. A portion of that isn't going to be taxed at a long term. So you're on the hook for a little bit higher tax bill maybe with this structure, but it's going to be a lot easier for you to manage in your taxes. So there's a little bit of a trade-off there. But all those things together, along with the lower fee, we think that's probably one of the better strategies out there right now.
That wraps up our final episode of 2025. Thanks for tuning in over the holidays. Investing Insights will return on January 2nd with a new episode. I'm talking with Morningstar Holland's market strategist, Michael Field, about investment opportunities beyond the Magnificent Seven. Thanks to senior video producer, Jake Van Kersen, and associate multimedia editor, Jessica Bebel. I'm Ivana Hampton, lead multimedia editor at Morningstar. Have a safe and happy new year.